Good morning. It's Wednesday, the 7th of May, and this is Govindraj Ethiraj, headquartered in broadcasting and streaming from Mumbai, India's financial capital. Our top stories and themes. The stock markets show surprising resilience in the face of uncertainty. Asian currencies are charting new and unexpected paths. India and the UK announce a much-delayed free trade agreement. Dramatic customs reductions in some products may be coming. Indian apparel could be a major beneficiary of the new UK FTA.
This is a core report with Govindraj Ethiraj.
India's resilient markets. Indian markets are displaying an unusually high sense of resilience in the face of increasing tensions, despite the government asking several states to conduct mock drills on May 7th, suggesting a greater preparedness for armed conflict. There was no real impact on the benchmarks, reflecting, of course, strong flows, but also a perception that any escalation would be of a limited nature. We will have a foreign affairs expert on this shortly. The indices opened in the positive and then started sliding down. The Sensex was finally down 155 points to close at 80,641, while the NSE Nifty 50 was down 81 points to close at 24,379. The broader markets were hit more, with the Nifty Mid-Cap 100 and Small-Cap 100 falling about 2.2 and 2.5% each. A report in the Business Standard says that foreign institutional investors' long-short ratio in index futures has now risen to its highest point since October 2024 at 0.94, which suggests that FIIs are the most bullish in 7 months. This, of course, is also evident from the flows, but this is another indicator. The long-short ratio, Business Standard explains, is basically the number of open positions on the buy side of trade in the index futures versus the number of open positions on the sell side of trade. A ratio below 1 implies higher open positions on the sell side of trade and vice versa. Foreign portfolio investors have been net buyers in the NSE futures and options segment for the last 5 straight sessions. And in general, the Sensex and Nifty have now recovered close to 10% since their April lows, which does make it a sharp comeback. But the IPO markets are now experiencing the cumulative impact of too many bad or overpriced IPOs, which typically or mostly juiced out all the demand in the last year or so. Now, this is not an unexpected phenomenon, as it is how most market bull runs or runs have ended and or are usually accompanied by a flood of IPOs which ride the descent into a plateau where the current markets seem to be. At least 2 initial public offerings worth about $760 million are expected to be delayed, adding to a growing list of companies postponing plans for IPOs thanks to weak investor sentiment, according to Reuters. An electric scooter company called Ather Energy closed about 6% down, reversing gains after listing at a premium of 2% to its issue price. As many as 58 companies with regulatory clearance have not launched their IPOs due to the global market conditions, according to Reuters. The rupee slips. The Indian rupee slipped on Tuesday, tracking small losses in regional currencies as well as dollar demand from foreign banks, though a general weakness in the dollar prevented a further fall, according to Reuters, which added that the rupee closed at 84 rupees 43 paise against the dollar, down 0.2% for the day. The offshore Chinese yuan retreated from a near 6-month high hit on Monday on signs that the country's central bank may be unwilling to allow rapid appreciation amidst sharp rallies seen in other Asian currencies, most prominently the Taiwanese dollar, which we spoke about yesterday. The dollar index was down 0.1% at 99.7, and the dollar is down 8% against major peers this year on the back of all of that heightened policy uncertainty, according to Reuters. An Asian crisis in reverse. There's been a lot of focus on bonds and currencies, but not as much as the action that's picking up as a fallout of the new tariff regime that has been announced in the United States and the overall uncertainty in global trade and the United States policies in general. A wave of dollar selling in Asia is a dangerous sign for the dollar as the world's export powerhouses start to question a decades-long trend of investing their big trade surpluses in US assets, according to Reuters. Now, while this story is playing out, the fact that this thought is even being entertained, leave alone being acted upon, is a significant shift in global market outlook. The Reuters report says that ripples from Friday and Monday's record rally in the Taiwanese dollar are now spreading outward, driving surges for currencies in Singapore, South Korea, Malaysia, China, and Hong Kong. And these moves are actually sounding a warning for the dollar because they suggest that money is moving into Asia at scale and that a key pillar for dollar support is wobbling. Yesterday, we did report that surprising 10% two-day jump in Taiwanese currency, even as Hong Kong dollars was testing a strong end of its peg, as Reuters says, and the Singapore dollar has hit its highest in more than a decade. Louis Vincent Gave, a founding partner of Gavical Research, said that to him, it has a very sort of Asian crisis in reverse feel to it. He said this in a podcast referring to the speed of the currency moves. Vincent Gave has also appeared on the Core Report in the past. The history is interesting and useful to recall. A capital flight in 1997 and 98 led to currencies from Thailand to Indonesia and South Korea essentially falling through the floor and leading to economic ruin at that point. One result of all of this was that as these countries recovered, they began to accumulate dollars to protect themselves against a similar situation in future. Gavical Gave said that since the Asian crisis, Asian savings have not only been massive, but they've had this tendency to be redeployed into US treasuries. And now all of a sudden, that trade no longer looks like the one-way slam dunk that it's been for so long. Now, obviously, this break has been triggered by US President Donald Trump's aggressive tariffs, which has rattled investor confidence in the dollar and also the uncertainty that has come with it, given the fact that there is no consistent policy on tariffs. All of this has meant that the flow of trade dollars into US assets has been upended. Asia's biggest piles of dollars sit in China, South Korea, Taiwan, and Singapore, which combined number in the trillions, says Reuters. In China alone, foreign currency deposits in banks, mostly dollars and mostly held by exporters, were close to $960 billion at the end of March, the highest in nearly 3 years, or that's almost $1 trillion. There are signs that the dollar view is shifting from all corners. Goldman Sachs said in a note on Tuesday, saying that investor clients had recently flipped from short yuan positions to long positions, or they were shorting the US dollar, expecting further weakness. Reuters also reported Hong Kong's de facto central bank saying on Monday that it's been reducing duration in its US Treasury holdings and diversifying currency exposure into non-US assets. The other somewhat startling view quoted by Reuters was from Arindam Sandilya, a Singapore-based global forex strategist at JP Morgan Chase, who said, again in a podcast, that the large and synchronized nature of currency appreciation is fueling stock of some sort of currency accord amongst the region's central banks, referring to Asia. Bloomberg reported that Taiwan's dollar led gains amongst 16 major peers tracked by them earlier, jumping the most as it did in more than 3 decades on an intraday basis. The yen also rallied about 0.9%, leading the advance amongst the group of 10, while the euro was above the $1.13 mark. The larger question, I guess, for someone sitting here is, what does this Taiwanese currency movement mean? Well, the global head of Forex at Jefferies told Bloomberg that the rally in Taiwan's currency has the potential to spill over to the rest of the developing world, or it portends some sort of currency agreement between the United States and China or the US and the region that will result in all Asian currencies strengthening. India and UK sign a deal. Prime Minister Narendra Modi on Tuesday said India and the United Kingdom had successfully concluded an ambitious and mutually beneficial free trade agreement along with a double taxation avoidance convention. Prime Minister Modi said that he was delighted to speak with his friend, Prime Minister Keir Starmer, and in a historic milestone, India and the UK have successfully concluded an ambitious and mutually beneficial free trade agreement along with a double contribution convention, he said, and added that he looked forward to welcoming PM Starmer to India soon. For Britain, a trade deal with India is crucial as it tries to recalibrate its post-Brexit trade relationship with the world in general. India is also the UK's second largest source of foreign direct investment, in case you knew that or didn't know that. For India, this is a major FTA with the fourth largest export market and will obviously help ease out things somewhat. Total trade between UK and India stood at about $21 billion in the last year. Exports were at about $13 billion. That was up 13%. And imports were about $8.4 billion and down about 6.1%. Prabhu Damodaran, convener of the Coimbatore-based Indian Texpreneurs Federation, which represents about $7 billion of combined sales of apparel, told me the India-UK FTA could significantly boost India's apparel exports. The context he gave was that the UK imports about $19 billion in apparel annually. Of this, China holds about 21% share and Bangladesh has 18% share, while India is between 5 and 5.5% at about $1 billion. India faces import duties of about 11 to 12%. Now, if India doubles its share to 10%, it would mean over $1 billion in additional export volumes, according to Damodran. According to him, even with a duty disadvantage, India is already a preferred sourcing destination for UK buyers. And if the FTA includes clear duty concessions for textiles and apparel, then India's competitiveness will improve, especially against Bangladesh, enabling India to capture more share from both Bangladesh and China, he said. A Reuters report says India will slash tariffs on 90% of British products sold in India, from whiskey and medical devices to machinery and lamb, with 85% of those becoming tariff-free within a decade. Whiskey and gin tariffs will be halved from 150 to 75% before falling to 40% by the 10th year of the deal, helping Britain's Scotch whiskey industry and making it cheaper in India, which is also the world's largest whiskey market. India will also cut automotive tariffs to 10% from over 100% currently. Other British goods which could face lower tariffs include cosmetics, aerospace, lamb, medical devices, salmon, electrical machinery, soft drinks, chocolate, and biscuits, according to that Reuters report. Britain has also agreed to reduce tariffs on some products which were relatively lower than India, but leaving about 99% of Indian exports to Britain facing zero duties. It will also remove a tariff on textile imports from India, as we just pointed out, which will help India's apparel industry and it will open up export opportunities further for sectors like marine products, leather, sports goods, toys, gems and jewelry, engineering goods, and auto parts. Blockchain and financial assets. Last week on Build on Blockchain, we explored how Aadhaar, DigiLocker, and blockchain can come together to build secure, decentralized identity systems. With Aadhaar as the foundation and DigiLocker offering verified documents, blockchain could add and will add user control and transparency. This week, we're joined by Arish Sharma, the former Director General of the Unique Identification Authority of India, and also until recently Chairperson of the ONDC. He's also the Chairperson of the Algorand India Advisory Board. Dr. Sharma, who has worked on the foundations of India's digital infrastructure rollout, including the India Stack, joins me to talk about how blockchain could enhance trust, transparency at scale. I began by asking him to take us through how blockchain works in the context of more security for financial transactions. Finance is the other use case, and there are so many linked, solutions and problems to solve. What, according to you, in the finance ecosystem, whether it's KYC or others, is, let's say, a problem that we need to, where we could apply blockchain solution?
Yeah, because basically what can happen is that the data credentialing is one important issue. So therefore, what I can do, I can basically put my data credential part on the blockchain and then easily, seamlessly share that. I mean, I don't depend on an institution to enable doing that. But I can myself, once public blockchain is allowed, thereafter, I am allowed to put my data onto that blockchain, and that data can be seamless. I can share it. So now this can happen in electronic KYC, because KYC is a very important topic. What is happening is that every bank is asking me to do re-KYC and, every fractured way of doing KYC, despite the fact that India has had digital KYC being done since last about 10, 11 years. Despite that, we have been, mutual funds have different KYCs, the banks have different KYCs. There is an attempt to make the central KYC and KRA, as they say, the common KYC, but it's still not in a great way. Blockchain could actually facilitate that, whereby I don't have to depend on any institution. I can just simply, enable that access of KYC. So some banks asked me, all right, Mr. Sharma, we want your KYC. I could just give them a consent token saying that fetch my KYC from this place. And he or she, the bank institution is able to do that. So this is one of another application of blockchain.
How do you see DigiLocker in all of this?
DigiLocker, as you know, DigiLocker is essentially like what can happen is that DigiLocker, for example, the documents themselves need not be stored in the DigiLocker. DigiLocker can become just the point where what could happen is that there are n number of documents. Those hash value of those documents are actually put in the DigiLocker. Now, how they are stored in DigiLocker, whether it is a blockchain or whether it is a database in a DigiLocker of the hash values, this is an architectural issue, and that can happen. But the basic principle of blockchain which means that immutability can be achieved using the blockchain technology in the DigiLocker.
I was thinking, for example, if it's my, let's say, college leaving certificate or the degree certificate, you don't actually need to upload the degree certificate, which you have to now.
Right. Absolutely. Absolutely. What you can do is essentially is that if there is a system of blockchain, then what you can do, the DigiLocker, you can just create the hash value of that and put it on the blockchain. That becomes the place where you can share. So, for example, let me put it this way: in the health space again, hospitals are creating these records, right? Patient records. Now, if they are somehow put it somewhere, wherever they want to put it, that's records is not really the issue. If they can just put the hash value of these records in a blockchain, that itself becomes a very good way of data exchange, of the certificate exchange. Similarly, DigiLocker part also the same thing can happen, whereby it becomes easy for anybody to just share the data.
Decoding the India-Pakistan tensions. The Ministry of Home Affairs on Monday evening asked several states to conduct mock drills on May 7th, that's today, amidst rising tension with Pakistan in the wake of the Pahalgam terrorist attacks of April 22nd. The drills would include air raid warning sirens, crash blackout measures, and training civilians to protect themselves in the event of an attack, among other things, and they would be organized across 244 categorized civil defense districts in the country. To get a sense on how India is approaching this situation currently and also to understand what would drive India's response going forward, I reached out to Indrani Bagchi, CEO of Foreign Affairs and Leadership think tank Ananta Centre, also columnist with the Times of India. And I began by asking her how she was reading things now, but also to give us a sense on how India has responded to such threats and actions in the past.
I'd say from the past 25 years, there used to be terror attacks, and we've seen some really brutal, horrific ones. The response used to be more in the diplomatic sphere, because in isolating Pakistan, condemning them publicly, closing down the dialogue process, we've gone through that. In 2002, we even had Operation Parakram, which was basically lined up the Indian army along the border. This was after the parliament attack on 13th of December 2001. Operation Parakram, which was the sort of forward deployed Indian army, that sort of closed down, shall we say. People retreated after about 7-8 months. But then 4 years later, we saw a series of terror attacks all the way until 2008 Mumbai attacks. Again, the response was mainly diplomatic. There was no military response in that sense. Move forward to 2015, 2016, the Pathankot attack, and then the Uri. For the first time, India turned its response into a military response. So there was a military response to the Uri attack in 2016, where Indian soldiers actually went across the line of control, demolished some of the camps. Cut to 2019, after Pulwama, we had the Balakot strike. More or less, been a ceasefire since 21. So we've been reasonably sort of, shall we say, unused to a military attack. That's been the trajectory of the thing so far. But the evolution has been from a diplomatic to a military response. This time, I think we are again looking at a military response.
That answers partly the question that I was going to ask. But really, if you say it's going to be a military response and you're saying the trajectory has now clearly moved into military responses, what kind could it be? And what is the thinking, again, or what is the kind of thinking that would define our response?
See, couple of things. One is they've taken all the non-kinetic responses. So, we barely have a relationship with Pakistan even before this attack. Whatever little there was has now been stopped. I would say the most damaging non-kinetic response from India so far has been the suspension of the Indus Waters Treaty. Most people don't quite get what that might mean, and you can't actually see that happening right now. It will be devastating for Pakistan as we go along. Give it 6 months, give it 8 months, give it a year. It's a long-term damage that Pakistan will have to live with. And that damage will be in many, many different ways. But that is still not missiles flying at each other. So what's the kind of thinking in Delhi? From all the diplomatic conversations that the minister, foreign minister, and the prime minister has been having with their interlocutors, they have basically readied everybody that there will be a military response, whether it is a multiple strike response or a single response which does not merit a retaliation. Because one of the things that we don't want, no Indian wants certainly, is a full-scale war. Nobody wants that. I don't think even the government wants that, but they do want to show a muscular response. And there is space in the world to accommodate that response. What we don't know now, there are two things here. One is India would be keen to avoid the mistakes of Balakot, and there were mistakes, very clear and obvious mistakes. So whatever they are planning, and I think they'll be waiting it out to sort of let tempers come down, etc., before launching any such thing. Also, a launch of this variety, of a military response of this variety to a nuclear armed neighbor requires a lot of planning. And I don't expect it to happen very soon, although I will probably be proved wrong because nobody really knows. But that's generally the thinking in Delhi. They want to keep the level of the war down, as in a restrained attack, preparing for a restrained response.
You mentioned mistakes. So what are the mistakes that were made then in Balakot which you feel people should take note of?
It was literally India's word versus their word. India basically said, yeah, we've killed 180, 200 people. Pakistan said nobody has been killed. Now, we had nothing to show that people had been killed. That onus of display of the damage. I mean, you can see what Netanyahu is doing in Gaza. It's all filmed. It's all on real time. That's reality TV. That wasn't there. Then we had this dogfight with the Pakistanis. We had ancient aircraft. We had a dogfight. Abhinandan fell on the other side. We shot down our own chopper on this side. There was some neatness that was lacking.
Now to the question that really listeners and viewers, I guess, want to know. How should businesses and markets be looking at this phase? And how long could it last? And is there an outcome that one would know of or could project or predict?
I don't think we are at a stage where all bets are off. I don't think we are at that stage. I'm pretty certain this government does not want to lose some of the economic momentum that India has. So they would be calibrating their response to ensure that damage, if any, to the economy is minimized. So I don't see any panic kind of activity among investors yet. Although tomorrow there is this security drill, I'm not sure how that will be received by everybody. But I think everybody is in a wait and watch mode.
Indrani, thank you so much for joining me. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.